Goals-based asset allocation is an investment framework that focuses on achieving specific financial objectives rather than maximizing portfolio returns relative to a benchmark. Unlike traditional asset-only approaches, goals-based investing recognizes that investors often have multiple objectives with different priorities, risk tolerances, and time horizons. Examples include retirement income, education funding, charitable giving, or wealth transfer goals. Assets are divided into separate subportfolios, each designed to support a particular objective. This structure allows investors to tailor risk levels and investment strategies to the importance of each goal. As a result, goals-based investing aligns portfolio construction more directly with personal financial outcomes and long-term planning needs. A key feature of the goals-based approach is the prioritization of objectives. Higher priority goals are generally funded using more conservative investments because failure to achieve these objectives would have significant consequences. Lower priority or aspirational goals can be supported by portfolios with higher expected returns and greater risk. This framework creates a hierarchy of subportfolios, each with its own return requirement and risk profile. By separating objectives according to importance, investors can allocate resources more efficiently and avoid taking excessive risk with assets needed for essential future expenditures. The approach therefore integrates investment decisions with the investor's broader financial planning process. Goals-based investing differs from traditional optimization methods because success is measured by the probability of achieving specific objectives rather than by maximizing expected return for a given level of risk. Investors focus on funding future liabilities or desired outcomes rather than outperforming market benchmarks. Risk is therefore viewed in terms of goal failure rather than portfolio volatility alone. This perspective can be particularly useful for individual investors, whose primary concern is often whether future financial needs will be met. By emphasizing objective achievement, the goals-based framework provides a practical and intuitive method for linking investment decisions to real-world financial priorities. In addition to goals-based investing, several miscellaneous asset allocation approaches are used in practice. Heuristic approaches rely on simple rules of thumb rather than sophisticated optimization models. Examples include age-based allocation formulas such as 120-age for determining equity exposure. These methods offer simplicity, transparency, and ease of implementation. However, they may fail to account for individual circumstances, economic conditions, risk capacity, or unique financial objectives. While heuristic approaches can serve as useful starting points, they generally lack the flexibility and analytical rigor of more comprehensive asset allocation frameworks. Investors should therefore apply them cautiously and supplement them with broader financial analysis. Another important consideration in asset allocation is the role of behavioral factors. Investors are often influenced by emotional and cognitive biases that affect decision-making. Fear during market downturns, overconfidence during strong markets, and loss aversion can all lead to suboptimal investment behavior. Structured asset allocation frameworks help mitigate these tendencies by establishing clear guidelines and long-term objectives. Goals-based approaches can be particularly effective because they focus attention on achieving personal financial outcomes rather than reacting to short-term market fluctuations. By maintaining discipline and adhering to predetermined strategies, investors improve their chances of achieving long-term success despite changing market conditions. The topic addresses rebalancing policy, which is the process of returning a portfolio to its target asset allocation after market movements cause weights to drift. Over time, differences in asset performance alter portfolio composition and may increase risk beyond intended levels. Rebalancing restores the desired balance among asset classes and helps ensure continued alignment with investment objectives. Without rebalancing, portfolios may become increasingly concentrated in outperforming assets, exposing investors to unintended risks. Rebalancing therefore plays a critical role in maintaining the integrity of a strategic asset allocation and preserving the portfolio's intended risk-return characteristics. Several factors influence the design of an effective rebalancing policy. Transaction costs are among the most important considerations because frequent trading can reduce investment returns. Asset volatility also affects rebalancing decisions, as highly volatile assets are more likely to drift away from target allocations. Correlations between asset classes influence the speed at which deviations occur, while the size of the portfolio and liquidity characteristics of investments affect implementation costs. Investors must balance the benefits of maintaining target allocations against the costs associated with trading. Consequently, rebalancing policies are often designed using tolerance bands or corridors rather than requiring continuous adjustments. A well-designed rebalancing policy enhances portfolio discipline and risk management. By establishing predefined rules, investors reduce the likelihood of emotional decision-making and maintain consistent exposure to intended sources of risk and return. Rebalancing also encourages a systematic buy low, sell high behavior by trimming appreciated assets and increasing allocations to underperforming assets. Although no single rebalancing strategy is appropriate for every investor, the underlying objective remains the same: preserving alignment between portfolio structure and long-term investment goals. Together, goals-based asset allocation and disciplined rebalancing provide powerful tools for managing wealth, controlling risk, and improving the probability of achieving desired financial outcomes over time.